This Friday marks the end of the month and, more crucially, the end of the third quarter. And what a quarter it's been. Well, when UBS issued its last global outlook report, they called it summer chill. Our next guest says little did they know it would end up turning into more of an autumn storm. Kelvin Tay is UBS Wealth Management's Singapore Chief Investment Strategist, and he joins us from there now. So, Kelvin, you said in your summer chill report that there was a likelihood of a temporary economic slowdown, but not a recession. You say that still remains your view. Why?
I think we're basically referring to the U.S. economy, and we believe that a lot of the high-frequency data that has actually been coming out is basically indicating that, yes, the slowdown is actually a lot more than what we had actually envisioned at the start of the year, but it doesn't mean necessarily that it actually gets into a recessionary sort of condition. So we still stand by our view that, yes, we are likely to see a slowdown, but we're not likely to go into a second recession where the U.S. economy is concerned.
Why not?
If you look at a lot of the high-frequency data that's actually been coming out, like for instance last night the GDP numbers were actually revised upwards. The housing numbers are also showing some signs of stability. We believe that, yeah, things could possibly actually pick up towards the end of the year. A lot of the slowdown was also due to temporary factors like the earthquake in Japan in the second quarter of this year, which basically affected the global supply chain. And therefore, once that is actually passed, we believe that a lot of the economic activity that actually slowed as a result of that should gradually start to come back again.
A lot of commentators are voicing concern that Europe could push the world into a recession. I see that you actually think the euro as a currency is one of the best positioned in the current environment. Why do you say that?
Okay, the euro in a certain way is probably best positioned in the sense that it has actually seen a lot of action right now and it has actually come off quite a fair bit. But we don't think that the ECB has got a lot more room to go where interest rate cuts are concerned with perhaps another round of 25 basis points before it actually bottoms out. And again, if you look at the alternative safe haven currencies, there are just none on the horizon. You can't go into the Swiss franc right now because of the fact that the Swiss National Bank has actually pegged it at 120 against the euro. And certainly the Japanese yen could perhaps be an alternative, but again, it is also already very, very high. So yes, it is more of a lack of alternatives where the safe haven currencies are concerned than we would say be trading on the fundamentals of the euro economy. That's why we think that the euro could perhaps be one of the better obvious choices to actually hold on to in the next 6 to 12 months.
That seems quite optimistic compared to what I've been hearing from other currency strategists. Hans Redeker, for example, the other day saying he expects the euro to drop to $1.25 on the weak fundamentals here in the political situation. How do you see the European sovereign debt crisis panning out?
Yeah. I mean, on a short-term basis, if there is heightened risk aversion like what we saw a couple of weeks ago, then certainly we will see the euro actually weakening like all other major currencies vis-a-vis the US dollar. But I think on a medium to longer term basis, the downside risk for the euro in relation to the US dollar is probably more or less not as much as what I think the markets are likely to envision it to be. And the reason for that is, again, because of the lack of alternative safe haven currencies there. Now, with regards to the Eurozone situation, we believe that the Greeks will have to default, and they will have to default by March. Now, increasingly, chances are that, that the ring-fencing of the crisis to just Greece alone, chances are that it might actually work out by March. And if it does work out, then I think the markets are likely to actually react more positively towards that. Therefore, on a short-term basis, that might actually turn out to be better than expected.
Now, Kelvin, just give us your equities strategy very quickly if you can. You say you like emerging markets, China and Thailand in particular.
Yes, on a short-term basis, we believe that the markets with the domestic sizes, like for instance China, could actually weather out this crisis better than the markets which have a lot more exports geared towards the advanced nations, simply for the fact that the advanced nations are slowing down dramatically.
All right, Kelvin Tay, we thank you very much for sharing that with us, Chief Investment Strategist at UBS Wealth Management in Singapore.